Hi, this is Mike Larson from Money and Markets TV. I've been growing more cautious on the markets for months now, and it's no secret why. The global economy is slumping badly. The euro crisis is deepening by the day. Fiscal policy is frozen, and monetary policymakers are out of bullets. And now we're getting multiple warning signals from the markets. In the currency markets, the euro plunged to 122 and change against the US dollar, its lowest level since July of 2010. The anemic rally in the US stock market failed right at technical resistance, around 1370 on the S&P 500. That opens the door for stocks to retest the June lows around 1262 and maybe even head lower. Meanwhile, overseas stock markets continue to fall like a rock. China's Shanghai Composite Index just hit a 6-month low, while Brazil's Bovespa is trading near its lowest level since October. And now, all those so-called experts who point to corporate earnings to support their claims that everything's fine are being forced to eat their words. Just in the past few days, we've gotten profit warnings from major semiconductor firms like Advanced Micro Devices and Applied Materials, heavy industrial and transportation companies such as Cummins and Ryder Systems, and big consumer names like Ford Motor, H.H. Gregg, and Burberry. In fact, the ratio of negative to positive profit guidance announcements is running at 3.3 to 1 for this quarterly earnings season. The last time the number was that bad was all the way back in the fourth quarter of 2008, when we were in the depths of the Great Recession and the Dow was trading in the 8,000s. What's really making me think we're in for some big potential declines are the warnings coming from the bond markets. First of all, the divergence in interest rates between perceived safe haven countries and those with huge debt problems is exploding. For example, the yield on the US 5-year Treasury note is close to its lowest level in history, and Germany just auctioned off 10-year notes at a yield of 1.31%, the lowest ever. On the other side of the coin, Italy's 10-year notes are yielding 5.8%, while Spain's benchmark rates are hovering around 6.5%. To really hammer home my point, I want to show you a chart of the spread between yields on the 10-year and 2-year Treasury notes in red, compared to the S&P 500 index in blue. Normally, the two lines move roughly in tandem. Like stocks, the 2-10 spread tends to rise when the economy is expanding and investors are willing to take on more risk. And it sinks when the economy is weakening and risk aversion is gaining steam. And true to form, it's now falling to levels we haven't seen in more than 3 years. In other words, it's sending off a huge warning. But the stock market isn't paying attention yet. It just keeps on rising as investors rest their hopes on one ill-conceived Federal Reserve program after another. This time, the market's apparently expecting another round of quantitative easing, and I think that may happen. But like past programs, its impact will be fleeting and it will have no positive effect on the real economy. So I think it's only a matter of time before we see those two lines I showed you earlier converge again, and not because bond investors are going to get more optimistic, but because stock investors will run and stocks will tank. So please, if you haven't already dialed down your stock exposure, or added protective positions like inverse ETFs and put options, please do so now, before it's too late. I'm Mike Larson for Money and Markets TV. Thanks for watching.